risk then, exactly?
The term risk gets bandied around a lot in trading circles. For everyday occurrences, it can be defined as a situation that exposes you to danger. For example, when you drive a car, you are exposing yourself to a certain amount of inherent risk. Most of the time, driving is completely safe, but accidents can and do happen. Some are in your control and some are not.
And does the same apply in trading?
Yes, in trading, the principal danger is losing money. Like a good driver, a good trader will know about the risks.
Can you give an example for trading?
Well, the obvious example is simply a losing trade, but there are others, which we will look at throughout the course.
But as a trader, we must place trades. So basically, there's no way of avoiding risk.
Well, this is partially true. Trading does involve risks that can't be avoided. You can't trade and be completely risk-free. However, you are in control of when you decide to trade, and by deciding factors like the trade size, your leverage, and how much risk you choose to expose yourselves to, as a trader, it's your job to know about the risks that come with every trade and to decide whether the risk is worth pursuing for the potential reward at the end of it. Hopefully, this course is the start of working that trade-off out.
Okay, so although we can't avoid risk altogether, we can control how much risk we expose ourselves to.
Yes, as a trader, your aim is to find and set up trades that you believe have the potential for a disproportionate amount of reward for the risk involved. This is like our driver deciding to drive below the speed limit when it's a clear day and there isn't much traffic on the road.
That makes sense. You mentioned that there are different types of risk. What are they?
Well, there are 4 broad types of risk in retail derivative trading. There is market, leverage, liquidity, and counterparty risk. If a trader has an open margin position, without exception, they will be exposed to all 4 of these risks to some degree. Let's look at each of these types, one by one.
Okay, tell us about market risk.
Market risk is a collective term for the factors that might make asset prices move, because a trader can lose as well as make money when prices move. It's a risk. You will probably have heard commentators referring to market risk when talking about factors that make prices fall. This is because they are normally commentating on the general factors that impact long-only investments.
And what about when prices rise?
Well, because margin traders can go short as well, there is also risk that they will lose money when prices rise. Try to think of market risk as the factors that move prices across the whole market.
Okay, so these are risks that make market prices go up or down. Got it?
Yes, market risk is by far the most visible risk in trading. It's reflected in the flashing prices you see in the trading platform. Its impact is measured almost to the second by a trader's account statistics, because this is the type of risk that traders want when they trade. As traders, it's one of the risks that we talk about and we try to analyze the most.
Okay, I'm with you so far. What else do we need to know about market risk?
Well, market risk is also referred to as systematic risk. The 2 terms might be used interchangeably. Systematic risks are the factors that impact the prices of securities across the wider market.
So what would impact prices across the whole market?
There are many systematic risks, and some common examples are elections, economic announcements, inflation, interest rates, currency rates, changes to taxation, recession, and so on. These are by no means an exhaustive list. These and a great deal more can have a major impact on price in either direction across a wide range of financial instruments in a market. An important point to make is that if a trader trades indices, currencies, commodities, or government bonds, they are typically speculating on systematic risk. Unsystematic risks are those factors and events that only impact the price of individual securities, such as company shares.
So, I take it unsystematic risks are those that have less of an impact on the wider market.
Yes, spot on, but unsystematic risks can be just as significant, but even more from an individual security perspective, rather than a market-wide one. How they impact traders is largely down to the instruments traded.
Can you give us some examples of unsystematic risk?
Certainly, some examples for individual company shares might be the resignation of a CEO, a product recall, a new approved patent, a poor set of financial results, a good set of financial results, bankruptcy, and anything that impacts the price of that particular security and not those in the wider market. Again, this is not an exhaustive list.
Okay, so systematic risk affects the entire market and unsystematic risk affects individual securities.
Next up, I'm going to introduce something called volatility.
I've heard that term before when people talk about the market being volatile. It doesn't sound like a good thing.
Well, it's not as bad as it sounds. It's a bit complex, but market risk isn't just about the risk of prices moving. It's also about how quickly they move, which is known as volatility.
Oh, I see. That doesn't sound quite so bad.
Volatility is the rate at which a price changes. Some markets have prices that change very quickly, others less so. Let me show you on a chart. You'll be able to see what I mean. This is a security with a relatively low volatility. And if I overlay a security with a relatively high volatility, you should see, despite making broadly the same move over the course of the chart, the price changes more.
Yes, I can see that. It jags around a lot more. So, which markets would you describe as volatile?
Well, for the time being, we won't go into a specific market. You just need to be aware of what volatility is at the moment. So, we actually discussed leverage in an earlier module.
Yes, that's right. You said that leverage is created in margin trading when traders borrow money to increase the return on capital.
Yes, well remembered, Maria. Traders use leverage to enhance returns. Going back to our BP example, let's say we bought 100 shares at £5 each. If you did this in a cash market and purchased the shares outright, you would need £500 to invest. Do you agree?
Yes, that's right. £5 times 100 shares.
In margin trading, however, you might only need to put up £50 for those 100 shares, with the broker in essence lending you the 450. This is in effect the leverage, with the £50 being deposited with the broker.
Yes, I remember that example from earlier. Thanks for the recap.
So the main benefit of leverage is that it significantly enhances our return on investment on profitable trades. The second benefit is that theoretically it gives you a larger pool of resources to trade.
Ah yes, it's all coming flooding back.
Good. So say we decided to use all £500 as the margin and increase the number of equivalent shares to 1,000. This would give us a total exposure of £5,000. If you placed the same trade and exited when the price hit £5.50 as before, instead of £50, you would make a £500 profit. The 450 additional profit is down to the trader exposing themselves to leverage risk.
I see. The share price has done the same thing. It's gone from £5 to £5.50.
Quite right, but as we know now, leverage is linear, and if the price moved against the trader, in the same proportion, the trader would also lose that amount. In our example, if the price fell to £4.50, the trader would lose £500. That's all the trader's capital, and they've just been wiped out. Can you see the risk now?
Yes, it's a sizable risk. How might we manage it?
Let's look at that in a moment. This is probably the most poorly understood risk by new traders. Interestingly, in some countries, the regulator limits leverage as a way of forcing traders to not overuse it. That should give you a pointer as to how badly it can be managed. Regardless, managing leverage is really down to the skills of the trader and being disciplined.
How so?
Well, brokers will publish a minimum amount of margin they will allow traders to have for a trade, normally as a percentage of the notional trade size. Remember, the lower the margin, the higher the leverage. So this is actually the maximum leverage a broker will allow. The important point I want you to understand is this is in no way the recommended or appropriate leverage level. Remember, the broker is likely execution only, and it's not its job, nor would be expected, to recommend anything. Novice traders that rush in, new to margin trading and believing that trades can never go wrong, will try to maximize trading resources and trade at the broker's published margin level. They end up having a run of losses, enhanced by being over-leveraged. They get wiped out very quickly and disgruntled.
So we shouldn't trade at the published minimum margin level?
No, I'm not saying that. It might be the right thing to do. I'm saying the best way to manage leverage is to have a plan beforehand. Define the amount of leverage you are happy with based on sound analysis and stick to it. Be disciplined in your approach and don't get greedy, even if your conviction and the commercials of the brokers lets you.
Good, that's understood. But how do I know what the right margin level is?
Well, unfortunately, that's not in the scope of this course, so I'm sorry. We'll look at how to set up a trading plan in a later course, and leverage is a key part. For now, just be aware, new traders can easily over-leverage themselves. Moving on, we are going to look at liquidity risk.
I can't say I've ever heard of this before.
Don't worry, I will explain it in detail. Liquidity is the amount of willing buyers and sellers in the underlying market at any one point. If either were to disappear, you wouldn't have a market anymore.
Yes, I understand. You need market participants to want to both buy and sell for there to be a market.
That's right. In derivative trading, brokers rely on being able to offer a sell and a buy price on the spread bet or CFD that you as a trader are trying to trade. If there are lots of market participants trading in the underlying market, the broker can be confident the market price is a valid one. If only a few participants are trading, then the broker is less confident.
Okay, I think I'm following. But how is this a risk?
Brokers typically deal with significantly reduced liquidity by increasing the size of spread they quote for that particular market.
I'm a bit lost now.
Well, don't worry. Do you recall that spread is actually a cost?
Yeah.
Effectively, brokers and the wider market deal with an underlying price that they aren't too certain about by increasing the amount it costs to trade. If traders have an open position and need to close it there and then, it can become very expensive, hence the risk.
Right, this makes more sense now. So brokers increase trading costs when the market liquidity is low, which can make it difficult for traders to close a trade, and that's where the risk factor comes in.
Got it in one, Rachel. This is the most common liquidity risk that derivative traders experience. It happens every day in some of the 24-hour markets when trade gets quiet overnight. But experienced traders know it's more expensive to trade in these overnight markets because the lower liquidity is expected. The real problem occurs when liquidity dries up, when it's unexpected. That's why, if you remember back in our costs of trading lesson, I said traders starting out should consider fixed spreads. This is partly to counter the risk of an unexpected reduction in liquidity.
Only partly?
Yes, in the worst case scenarios where no trading occurs and there is no liquidity and no one can price the market, trading gets suspended, so fixed spreads aren't relevant. Although this is very rare, it does happen. By way of a case study, I would suggest that you look at the articles in your lesson materials. These are about the Swiss franc unpegging, which created a big liquidity issue. It's an interesting read.
Thanks. I'll make sure I read those articles. So what can we as traders do to manage liquidity risk? Do you have any more pointers?
Well, like I said, fixed spreads are a good tool because they remove the broker's ability to suddenly widen spreads when there is an unexpected reduction in liquidity. Of course, they don't remove the risk altogether and the markets can still be suspended. Trading in more liquid markets like currencies also reduces liquidity risk, but it's a risk traders cannot eliminate entirely. The last type of risk we'll look at in this lesson is counterparty risk. It won't take long because we've already covered off how to best manage the risk in our section on regulation.
Enlighten us.
So a counterparty is the entity with which you entered into a trade. In retail derivative trading, this is your broker. The risk is that your counterparty doesn't or cannot pay. This can be for a whole host of reasons, the obvious one being that they go out of business, but in some cases they simply don't pay, which can come about as the result of poor regulatory enforcement.
Okay, I don't like the sound of that, so what can we do to manage this risk?
Counterparty risk is very difficult to assess and measure. It's down to the risk that the entity that you are trading with takes, which is all about impossible to judge as an individual trader. As individuals, you will place a reliance on the regulator here. It can be reduced significantly by going with a broker that is subject to FCA regulation and ultimately the FSCS, which we've discussed previously.
Okay, so we can be confident when using a FCA regulated broker.
Yes, I'm going over old ground here, but the FCA has strict rules which help reduce your counterparty risk.
Yes, I remember.
Excellent. If you don't, please go back and remind yourself what we went through on regulation. Next, we are going to summarize this lesson.
In this lesson, we've looked at risk. We've explored the different contexts in which traders are likely to come across it, as well as the different types. There are four main types of risk: market, leverage, liquidity, and counterparty risk.
Market risk is concerned with the factors that can move market prices against you. Prices can rise and fall and have a negative impact on your capital. It can also have a positive impact, and it's the risk traders want. Market risk is also known as systematic risk, which impacts the price of securities across the whole market. Unsystematic is the risk that impacts individual securities.
Leverage risk is inherent in all margin trading. It's when traders borrow money to increase their return on capital or increase trading resources. It's best managed by having a plan in place before you trade and making sure you stick to it.
Liquidity risk is concerned with the amount of willing buyers and sellers in the underlying market. If either were to disappear, there wouldn't be a market, and more importantly, a price anymore. This risk can be partly managed by trading with a fixed spread broker. Other than that, trading in larger, more liquid markets like FX reduces liquidity risk.
Counterparty risk is the risk the entity you trade with doesn't or can't pay. As private traders, the best way to manage this is to go with an FCA regulated broker.
Good. Just knowing these risks exist, it's preparing you well. We've covered some basic methods to manage these risks in this lesson, largely in how you set yourself up as a trader. In the next lesson, we are going to go further into how to manage risks on a trade-by-trade basis. Well done. See you in the next lesson.